Yo guys, what's cracking today? This is Riley of the Big Thinking Aussie here, and today we have a video where we're going to be talking about how to create a diversified stock portfolio. So just ways to minimize risk in your investments. Also kind of how to make sure you have multiple revenue streams and different styles of stocks, i.e. your blue chips, your growth prospects, undervalued shares, as well as penny stocks. So we're going to have a discussion about all these types of different investments and how to minimize your risk by creating a diversified portfolio. So yeah, that's all to come, guys. See you there. So before we start talking about our different types of portfolios and what's included in those, we're just going to have a chat about what type of investor you are, what stage of life. I know that sounds really general, but here's why. So for younger investors, you're obviously going to have more of a work life in the future. Or you might have several years to make more money at work, and thus you'll have more savings to invest over time. So maybe you can afford to be a bit more aggressive with high risk stocks and think more about the capital gains that you'll be getting in the short term rather than the long term. However, that being said, in the long term, you're obviously going to want to have stocks that will give you dividends and returns over time. So creating a balance might be great for you as a younger investor. So stocks that you might be more inclined to look for could be small cap tech stocks. Just ideas I have are like the cannabis stocks, baby formula, entrepreneur type of businesses. However, if you're an investor with certainly more capital, you might seek to have a financial advisor on your side, such as someone from JP Morgan or Wells Fargo, a dealer who pays closer attention to markets and can give you some insight on what kind of moves to make and how to build your portfolio. So also consider that if you have the kind of capital to play with. And if you're an investor who might be older in life, then you might not have as much tolerance for riskier stocks. Thus, maybe investing in larger cap stocks might be better for you, such as banks, because you can live off their dividends from your work-life savings. So also that's something to consider. But regardless of this, of where you are in life, creating a diversified portfolio will allow you to minimize your risk. For example, if one company or one market decided to crash, for example, natural resources. I know Australia is quite heavily reliant on our resource market. For example, if that crashed, having a diversified portfolio would minimize the risk and the damage onto your overall wealth rather than your single investment in that stock. So yeah, make sure you diversify your portfolio so you can manage your risk better over time. So a typical balanced portfolio, there's a lot of ways you can go about this. Some people strive for more growth prospects, or some people want their stock portfolio to consist of blue chip. I prefer to have a balance of a few different types, which I'll go through next. However, if you don't have the capital to kind of play with that now, I'd also recommend going on plus 500 and using the demo mode, because you might because you're able to use 50k worth of virtual currency to kind of see how your portfolio would fare in the real markets. Anyway, 40% of your stock portfolio, 40 to 50 might be blue chip stocks, so such as bank shares, large cap ETFs, financials, your Facebooks, your Samsungs, your bigger companies which promote slow, consistent growth, have a large portion of the market share, and minimum risk. That's the whole point of having these blue chip stocks. They're usually quite expensive. You might even find some $100 to even $1,000 per share. However, you will get quite healthy dividends, and these companies will promote shareholder interests for your future financial stability. So that's why you'd want to have a large portion of your portfolio as blue chips. It kind of goes without saying, but anyway, 20% of your growth are your growth prospects, so such as your high earnings, little to no dividends. They're kind of purely capital gains sort of stocks. Usually companies in their growth stages who have, have been public for a short period of time and have a huge potential due to their rate of earnings and the rate of growth. So an example of that could be Afterpay. But why you'd want to invest 20% of your portfolio into this is just so you can be making money, and kind of the speed in which these stocks would grow would be a lot higher. So next, 20% of your portfolio would also be undervalued stocks. So this is more of an active investment strategy where you have to closely sort of analyze the market, really dig deep into your research. Perhaps maybe a media presence or investor confidence could be shaken, and thus the share value of some stocks would fall below the actual company's worth. And this could indicate potential upswing in the future in the stock price. So you buy in when it's low, just before it the cycle kind of evens out and the stock price picks up. So considering that, you have to be careful, because when you're actually doing your stock valuations, you might be looking at kind of plugging in these values and getting, this should increase over time. However, you never know what's going on behind these doors. Management changes or even permanent reputation damage may start a negative trend towards this stock eventually collapsing. So something to consider. You really have to do your research on these kind of stocks. But anyway, 20% of your portfolio should also be penny or small cap stocks. These potential stocks with high prospects of risk, but also high reward as well. So you have to kind of dig deep into the company structure, revenue streams, kind of the hype around these stocks and what you kind of think it might be in the future. However, there's obviously a lot of risk. I saw some figure like 10% of startup companies actually succeed past their third year of operation. So these stocks are very hard to pick, but if you do know and kind of see some stocks slowly start to rise, maybe get on board, and that could be a lot of potential growth for you in the future. An example could be like cannabis stocks, which a lot of people are kind of talking about lately in the sense that it's becoming legalized several countries overseas. So it can depend on legislative changes. However, it is definitely a market where there's a lot of demand for. So just in general, that was the kind of portfolio and how I'd weigh it out. But in general, you'd kind of want at least 60% of your portfolio, minimizing risk and providing your future stability also with dividends. Regardless of what stage, you kind of want the bulk of your portfolio to be certainly low risk, and you can do so using this kind of structure. You do need to kind of figure out what kind of stocks you prefer to have and do it like that. However, I'd recommend having about 30 to 40% of your portfolio being in potential stocks or undervalued stocks, as this is where your money can be made if you can thoroughly do your research and understand what's going on in these companies, as well as luck being on your side. Because with the stock market, you may think that a stock or a company is doing great and will continue to. However, you can never be too sure with the world's economy these days. So not only should you kind of consider setting up a balanced stock portfolio, diversifying it across a few markets, and investing in different types of shares like I've mentioned, I'd also recommend considering alternative investments and revenue streams. For example, your property investments. For a younger or someone with less capital like myself, maybe a unit trust could be a way that you could get in the property game and kind of get a small return over time. That way, if the stock market crashes, you at least have something which is a constant kind of revenue. So that being said, you could also create a business, invest in yourself or a close friend. The trick is to always do your research on how people are making their money, and understand that past performance is never going to be a reliable indicator going into the future. So you kind of have to, being a younger entrepreneur or investor like myself, you have to make sure that you are okay with accepting this risk and understand that the reward prospect can sometimes influence your decision making. Anyway guys, that's going to be it for the video today. I hope you really enjoyed, and I got you thinking a little bit about your investments, or whether you want to invest, or even just changing your strategy in general. But that was the kind of point today. I hope you all loved it. Like and subscribe if you enjoyed, and I'll see you all in the next one. Peace.